Welcome to The Explainer. Today we are unpacking an absolute modern classic in personal finance, The Simple Path to Wealth by J.L. Collins. Look, if you've ever felt completely overwhelmed by financial jargon, those intimidating stock charts, or the pressure to hire some expensive advisor who just speaks in riddles, you are in exactly the right place. We're going to clear away all that noise and lay out a straightforward, totally actionable roadmap to financial independence. It's really all about radically simplifying your money so you can maximize your life.
All right, so here is our game plan for today. We'll be walking through 6 key pillars. 1. Mindset and FU money. 2. Debt, the unacceptable burden. 3. The market always recovers. 4. VTSAX and index funds. 5. Accumulation versus preservation stages. And lastly, 6. The 4% rule.
Let's kick things off with Section 1, Mindset and FU money, which is truly the foundation of everything we're talking about today.
You know, true wealth building begins entirely in your head. Well, before we even touch on stocks or percentages, we really have to talk about how you view your resources. There's this brilliant little parable in the book about 2 boyhood friends. One grows up to be a humble monk, and the other becomes this rich, powerful minister to the king. Years later, they cross paths. The well-fed minister looks at the shabby monk and says, you know, if you could just learn to cater to the king, you wouldn't have to live on rice and beans. But the monk calmly shoots back. If you could learn to live on rice and beans, you wouldn't have to cater to the king. The point here? Wealth isn't actually about how much you earn. It's fundamentally about learning to live below your means. The less you need, the freer you are.
And that ultimate freedom brings us to what J.L. Collins famously calls, and excuse the language, but it's just so perfect, FU money. It is exactly what it sounds like. Have you ever just wanted to walk away from a situation? FU money means having enough saved and invested that you are completely free from the demands of anyone else. It means you can walk away from a toxic boss, you can take a year off to travel, or pivot your whole career without a single drop of panic. The ultimate purpose of money isn't to buy luxury cars or huge houses, it's to buy your freedom. It's the absolute power to live life entirely on your own terms.
So this entire philosophy is really captured in one single, incredibly powerful guideline. Seriously, if you take away absolutely nothing else from our time today, memorize this right here. Spend less than you earn, invest the surplus, and avoid debt. That is the entire simple path, anchored in one sentence. I know it sounds almost too basic to be true, but if you simply do this, you will inevitably wind up rich.
Which brings us to Section 2, Debt, or as we should probably call it, the unacceptable burden.
Because if wealth equals freedom, then debt is the exact opposite. It's the trap that keeps you catering to the king. J.L. Collins does not mince words on this topic at all. He says carrying debt is as appealing as being covered with leeches and has much the same effect. Think about it. When you hold consumer debt, your future income is already claimed by somebody else. You are literally paying for your past instead of funding your future. It's this massive wealth destroyer constantly draining your resources in the background, and frankly, it is an absolutely unacceptable burden if your goal is true freedom.
So if you're carrying debt right now, we need to treat this like a financial state of emergency. Here is your relentless action plan. First, list out every single dollar you owe. Second, slash all non-essential spending immediately. I'm talking every extra coffee, every takeout dinner, put it all on hold. Third, rank your debts by their interest rates. Fourth, pay the absolute bare minimums on everything except the one with the highest interest. And finally, pour every single surplus dollar you have onto that highest interest debt until it is completely crushed. Mathematically, this stops the absolute worst bleeding first. Then, once that one is gone, roll all that money into the next highest debt. Immediate, aggressive action is required to get your future back.
Now for Section 3, The Market Always Recovers. Once you've scraped off those leeches of debt, we get to turn to the real engine of our strategy, the stock market. Now look, it's completely normal to be terrified of market crashes, but history tells a wildly reassuring story. Back in 1974, the Dow was down to just 616. Then we lived through the terrifying Black Monday crash in '87, and of course the massive financial hurricane in 2008. But by 2015, the Dow had climbed to nearly 17,823. What's the critical lesson here? Despite world wars, global pandemics, depressions, and basically every big ugly event you can imagine, the market consistently recovers and pushes relentlessly higher. Human innovation and corporate drive just always push things forward. To really wrap your head around why the market always goes up, you've got to hear Collins' famous beer versus foam analogy. It's so good. Imagine a freshly poured glass of beer. The liquid beer at the bottom, That represents the actual operating businesses. Those are the companies out there innovating, selling products, and generating real, tangible value every single day. But the foam on top, that's the volatile stock prices, the daily panic, all those talking heads shouting at you on CNBC. That foam furiously rises and falls based purely on emotion. It makes for great TV, sure, but it is entirely just noise. The secret is to ignore the media hype, completely ignore the foam, and focus entirely on owning the underlying, wealth-generating beer.
Okay, moving right along to Section 4, VTSAX and index funds.
So, how do we efficiently buy all that beer? Well, as we just talked about, over the long term, the trajectory of the market is undeniably upward. It's going to dip, it's going to zigzag violently at times, but it always climbs. The only real danger to your wealth isn't the market dropping. It's you panicking and selling at the absolute bottom. And here's the best part. You don't need some super complex portfolio of hand-picked stocks to win. In fact, trying to pick individual winners usually just hurts you. Instead, you just need one simple tool that passively captures the entire market and lets capitalism do all the heavy lifting for you.
And that ultimate tool is the Vanguard Total Stock Market Index Fund, otherwise known by its ticker VTSAX. By owning this single, extremely low-cost fund, you basically own a microscopic piece of approximately 3,700 publicly traded companies in the U.S. What makes this so brilliantly effective is that it's naturally self-cleansing. Capitalism's brutal efficiency is literally working for you in the background. If a company fails, it naturally just drops out of the index, and your exposure shrinks. If a new company absolutely explodes in growth, its representation in your fund automatically grows. You don't have to guess the future, you're just guaranteeing that you always own the winners.
And hey, you don't just have to take the book's word for it. Even Warren Buffett, arguably the absolute greatest active stock picker in human history, actually endorses this exact passive philosophy for the everyday investor. He famously put in his instructions that upon his passing, the trust for his wife should put 10% of the cash in short-term government bonds and 90% in a very low-cost index fund. Why? Because mathematically, low-cost index funds beat expensive, actively managed mutual funds over the long run almost every single time. Simple isn't just easier, it's actually far more profitable.
Now let's talk about timing in Section 5, accumulation versus preservation stages. So how do we actually apply this strategy over a lifetime? Well, it boils down to two distinct phases. First, we start with the wealth accumulation stage. This is when you're young, you're earning money, and your goal is aggressive growth. The path here? 100% VTSAX. Yes, it's going to be a volatile, bumpy ride, but you have decades to weather the storms, and honestly, you can just buy more shares when the prices drop. But later on, you reach the wealth preservation stage. Now you're nearing retirement, you finally have your FU money, and you really can't afford massive drops anymore. At this point, you introduce bonds into the mix, specifically Vanguard's Total Bond Market Index Fund, or VBTLX. Bonds basically act as a shock absorber. They definitely don't grow as fast, but they hold steady when the stock market falls, which ensures you never have to sell your stocks at a huge loss just to go buy groceries.
Finally, let's look at the finish line with Section 6, the 4% rule. Okay, so you've made it. But how do you actually use your money without running dry? The answer is the famous 4% rule. Extensive historical studies have shown that if you have a portfolio heavily invested in stocks, you can safely withdraw 4% of your total nest egg during your first year of retirement. And then in all the years after that, you just adjust that exact dollar amount for inflation. Let's make that super concrete. If you have $1 million invested, you can pull out $40,000 in year one. Historically speaking, if you follow this strict mathematical rule, your money is going to last for at least 30 years, and in most cases, your pile of money will actually continue to grow. This 4% safe withdrawal rate is basically the golden key that unlocks your financial independence.
So, we've covered the simple path. Spend less than you earn, invest relentlessly in index funds like VTSAX, totally ignore the media foam, and just wait. But I want to leave you with the absolute most important question of all. Money is just a tool, right? The real question isn't about the math, it's about your life. Once you stay the course and you finally achieve your FU money, what are you going to do with your ultimate financial freedom? Where are you going to go? What are you going to build? The only way to find out is to start walking the simple path today. Thank you so much for joining me on this explainer, and I'll catch you next time.